Hedge funds. They may look exciting from the outside, but let me tell you why there's a healthy amount of risk involved with all that excitement. So, what is a hedge fund? A hedge fund is a pooled investment vehicle, very similar to a private equity fund or a venture capital fund. In fact, hedge funds were the first investment vehicles that used the LPGP structure that venture and private equity funds use today. That's why they're called alternative assets or alternative investments, because they're different from investing in like a mutual fund or directly in stocks. The same goes for investing directly in commodities. In a hedge fund, investors pool their capital into a fund as limited partners, and then the general partner, as the hedge fund, goes out and identifies different investment opportunities and deploys that capital into those opportunities. Very similar to how a private equity fund or a venture capital fund is structured and makes investments. The difference is that hedge funds have used kind of this black box investment strategy where they've identified some way to make money in the market using short selling, leverage, derivatives, a mix of private equity investing plus public equity investing, all kinds of different strategies. For example, George Soros, who's one of the most successful hedge fund investors of all time, he made a ton of money off of the British pound. Basically what happened was the British central bank said that we will buy the British pound at a set price in order to establish that price and hold it fixed. And what George Soros did is effectively he went to all these other people that were holding British pounds and bought them up at lower prices. And then he would go and sell them to the British central government and make money off the difference. It was an arbitrage strategy. Arbitrage basically meant that it was free money because he could buy a British pound for maybe $1 and then he could sell it to the British government for $1.20. And he ended up bleeding the British government practically dry. And they basically had to stop selling British pounds because otherwise they would have completely depleted their reserve currency. Another example of a hedge fund strategy is a belief that Airbnb is going to end up dominating the space for hospitality. So what you might do is invest in Airbnb on the private side while simultaneously shorting hotels on the public side. And then you make money on the difference. And then you could even add leverage, essentially borrowing money to finance your purchases of stock and shorts and drive even bigger profits. So there are a lot of different hedge fund strategies out there. Another strategy might be high frequency trading, where hedge funds use complex economic models to identify different trends and very small aberrations in prices that they can capture the delta on, where they know that it's going to sell for one price and they can buy it today at a slightly lower price and immediately sell it. Wherein they make literally pennies, but they make billions of these transactions every day, and so those pennies add up very, very fast. Might be another strategy where a hedge fund ingests a ton of data, analyzes that data, and then makes predictions on where stocks are going to move. So for example, if a company is coming out with their earnings report, the hedge fund could go and they could look at like what analysts are forecasting the stock to do. They could then ingest a ton of data about that company. So there are cases where like analysts at hedge funds have sat outside of parking lots of grocery stores or big box retailers and counted the number of cars in the parking lot or what have you to get some edge on information. And then they use that to predict if the stock is going to go up or it's going to go down based on what the market is forecasting and is expecting to happen with that company when they release earnings, and then generate a return that way. So a lot of different ways. And that's why I mean that it's kind of this black box where they've figured out some trading strategy that's working, and they use that trading strategy to generate what they call in the industry alpha, or essentially above market returns. The problem, though, is that over the long run, 90% of hedge funds have failed to beat the market. And that's probably due to a number of reasons, but one of them is what I call the money tree challenge. The money tree challenge is that money doesn't grow on trees. And if it did, as soon as somebody found out that there was money growing on a tree, they'd all rush to take all the money off the tree. And so there wouldn't be anything left. That's one of the big challenges with hedge funds, is that oftentimes they'll find a unique strategy that really works and can generate a lot of money, just like George Soros found this arbitrage opportunity with the Central Bank of England. But when other people find out about it, they also want to participate and grab some of that money off the tree, thereby reducing the amount of profits over time. And if a hedge fund hasn't come up with another unique strategy in the meantime, it can result in poor performance. The other thing is that oftentimes what seems like a no-fail, low-risk strategy for the hedge fund is really just the case of them not fully appreciating all of the potential risks, particularly black swan events. So this caught a number of hedge funds off guard back in the Great Recession in 2007 through 2009, where the belief was that real estate always went up and to the right until one day it didn't. And as it came down, that resulted in a number of complex financial instruments that were really dependent on real estate always going up to completely collapse, taking out tons of hedge funds and several investment banks with it. And then lastly, one of the challenges is, I did say 90%. That leaves another 10% of hedge funds that actually do beat the market consistently. The challenge is that those are almost impossible to get access to for the typical investor. In fact, in many cases, you have to be worth hundreds of millions of dollars to get access to those funds. And they are insanely secretive. They don't tell people anything about their trading strategies because of that fear of the money tree problem that I mentioned earlier on. So it's one of those things where, like, if you do have a money tree, you don't tell anybody about it. You keep it super secret and to yourself. This makes it really challenging as an investor in hedge funds to know, are you investing in a true money tree or are you investing in some short-term aberration? Either way can be okay, but you got to know what you're getting yourself into and be willing to take the associated risks. One of my favorite books around hedge funds is one that was written by Michael Lewis a number of years ago about high-frequency trading. The book's called Flash Boys. We'll have a link to Amazon where you can pick it up if you want to read it down below. In the book, though, he walks through what a number of these high-frequency trading platforms were doing. Essentially, what was happening was large money managers, like pension funds, would decide they wanted to go buy a particular stock. Maybe they're going to buy ExxonMobil. Well, they would issue an order to buy that stock. And effectively what the hedge funds were doing was they would see that transaction start to come across the wire, and they would then beat that purchase order to the buyer and buy it first. And then what they would do is they would essentially increase the price just a little bit. And so by the time the order came in, they had to buy it at a slightly higher price. Essentially, they were forcing a fee or a tax on these large money managers for having a slower internet connection at the end of the day than these hedge funds had. And it was all about trying to be as fast as humanly possible, having servers that were literally like right next to the central exchanges. Ultimately, that feels like an interesting strategy that could work in the short run, but over time would go away as more people found out about it and tried to replicate it, including those big money managers who came up with interesting solutions to cut out that tax. The other thing is these high-frequency traders have been accused of perpetuating all kinds of market crashes when their algorithms went haywire when something didn't fit and started just dumping tons and tons of shares on the market, perpetuating a crash. Hopefully this was interesting to you and you learned something about hedge funds and some of the associated risks with investing in them. That's not to say that all hedge funds are bad, but just know that they are incredibly risky instruments. You don't really get great returns without risk. As an investor, you got to be comfortable with your own personal risk tolerance before making those types of investments. As always, none of this should be construed as investment advice, so do your own due diligence before making an investment. Check out some of my other videos, like what's the difference between a hedge fund and private equity fund, because honestly, that line is blurring. And we'll talk more about that in that video. Thanks.